Good morning. Welcome to another episode of Momentum Mondays. Today is May. What is it? Today is May
19th.
19th, Monday, May 19th, 2025. Anyway, this is going to be a quick paced, um, sort of condensed version of this show. We've got some traveling going on. And so we also had some traveling going on last week, getting into the summer months. And so we will continue to do these as we can, but there may be the occasion that we um, miss 1 week or something, but we'll try to kind of make that keep that to a minimum. Anyway,
Yeah, yeah.
definitely talking about the markets this week or last week rather. Markets had quite the week last week. Can you hear me?
Yep. I can hear you. Yes, sir. No, it was great. Great week last week in various different sectors. Some pretty exciting stuff going on. But before we hop in, keep in mind that this podcast and all information contained within it are for educational, informational purposes, a little bit of entertainment. Always reach out to a financial advisor that you trust or visit us at momentumwealth.us and be more than happy to give you a free consultation and talk about your specific situation.
Yeah, that's good. You're a little delayed for me, so we'll see if it ends up that way in the final version, but we'll press on here. Last week, really solid week. There are maybe some underlying things that are still a little concerning, but we had the S&P up 5.29%, the Nasdaq up 6.87, the Dow Jones up 3.5%, Russell 2000 up 4.5. Commodities, kind of a different story. Gold down a little over 4% on the week. Silver down 1.6 on the week. 10-year bond price down, which means yield up, as we've talked about before. Bitcoin down a little under a point on the week. And so we had a lot of advancing last week, but it was sort of uh, a lot narrower than I would like to see, than a lot of people would like to see. And so this for us is not um, indicative of like the worst is over, the volatility is gone. We're through it. I hesitate to make that call. I could be wrong. I would readily admit that if we are, but I think that there are still some things, both in the bond market and on the breadth side of things, that are not where they would need to be to have this be something that is sustainable. You also have a lot of the pumping happening on the heels of an announcement with China about kind of a pause in tariffs, but they're still saying that those are going to be implemented at some point later on. That may also have an effect where we get a kind of a temporary reprieve, but it's not necessarily something that is going to stick around. We wouldn't shock me if we had another pullback. I don't know how big that would be, but these are just kind of the things we're looking at and things that we're thinking about when we're looking at these big moves in the market. We did
Yeah,
have one of our indicators move in a positive direction. We did go a little bit more in the market last week. We still have one that's out, a pretty big one that's out. So that one is, I don't think that I would say it's close, but it could surprise us if we do have some more strong movement in the market over the next week or so.
yeah. And one thing you always have to keep in mind when you have whether they be black swan events, really like liquidity events, or some people will refer to them as a watershed event in the market. You can have something that starts it, but a lot of times it really evolves and transitions into a credit issue. We are a debt-based economy. Everything revolves and runs on debt. And when you have the types of liquidity events that we had on the heels of a change in tariff policy, a lot of times, regardless of kind of what happens with tariffs, and we do know, and it's kind of peculiar when you're really paying attention to what's going on, aside from just what the news is telling you. Um, the Chinese tariffs are still going to be triple, quadruple, maybe even quintuple once all the negotiations are done than what they were last year. So you still are going to have a very strong tariff policy, regardless of whether or not it's 150 or 200%, or if it's just 50%. That change that is really becoming secular and structural, a structural change in trade policy, that's going to be lasting. We saw this happen from 2016 into um, the change of administrations 2022, 2023. Tariff policy really didn't change. There was a little bit of change on the margins of enforcing certain agreements, but actual tariff policy really didn't change. So I don't suspect too much changes as it pertains to the trend that we're on, but I think now it's very possible that we've transitioned into more of a credit driven, um, you know, uh, flat market, um, pullbacks. And we're even seeing, headline news today. Moody's, I believe it's Moody's, has joined the Standard and Poor's, and Fitch, and placed in the U.S. government credit rating a notch below AAA. They have different designations, but just think of it, instead of it being a 10 out of 10, it's a 9 out of 10. The first change happened in 2011 with Standard and Poor's. The next change happened by Fitch in 2023. And this just kind of puts a bow on it, wraps it up here. 2025, Moody's, joining the rest of the credit agencies, have given the U.S. credit a 9 out of 10 versus a 10 out of 10. Don't really think that's going to have a material impact, but it does kind of give you a little bit of context if things really have started to transition away from just being a tariff driven tantrum to being more of a credit driven tantrum that the market is going through and may continue to go through.
Yeah, I mean that's it's a good point about kind of it bringing in line with all the other ones they had back in 2011 and then Fitch back in 2023. Um, Kind of they cited different reasons for their lowering of the credit rating. Mm. And so this does kind of bring everything back in line with all of the credit agencies have the federal government, the US government, one notch below what we would consider a perfect credit. So, or perfect credit rating rather. Um, so if we look at um, let's see, we look at we're not market's not open for us today yet right now, but suggesting that the market's going to open a little lower today than it otherwise would have based on Friday's or last week's market action for sure. And that can be blamed on a number of different factors. The factor at large is probably going to be the Moody's downgrade. I would imagine that's what you're going to see in the news cycles this week. But just kind of keep an eye on that. I think volatility is still the name of the game. I don't think we're past that. There's a lot of things, like I said, both in the bond market and in the very narrow driven kind of tech cycle. The NASDAQ really kind of soared last week with the AI names again. And so we would want to see a more widespread path there for more people to follow, more companies to follow that trajectory upward before we would feel confident to say that maybe the worst is behind us. I don't know. It could be. Maybe we have a pullback. Maybe it's not quite the pullback that we had thus far this year. Anybody's
Yeah,
guess, really.
yeah, man. My bias is to that wick down that we had about 45 days ago is probably the cycle low. Gonna have to wait and see, of course. That's why we pay attention to the data. And it's interesting, we had a lot of discussions this last week, um, with prospects, with clients. And one conversation in particular was very interesting as it pertains to exposure to artificial intelligence, robotics, genomics, blockchain technologies. And, at the end of the day, regardless of changing technologies or the cycle that we're in, paying attention to the data will always lead you to the right place. It'll lead you towards overweighting what is going to have the tendency to outperform your current portfolio. It's going to have the tendency to give you the ability to outperform what you're doing in your 401k. And so that's what we do here is we pay attention to the data and allow that to lead us to the right path.
Yeah, that's a good point because sometimes it feels like maybe that's a hard thing to sit through because you're kind of maybe, it's it's a difficult thing. This is a hard market environment right now, and you can read that across any kind of tech writer or financial analysts you read, they basically the consensus here is this is a very difficult market. And so what that means is that um, because of all of the moving parts with tariffs and things that are going on economically, you've got the credit agencies lowering the credit rating. All these kind of things are happening simultaneously. This is a very difficult market to trade in, and so you can be getting mixed signals that are not extremely clear. This has kind of been a theme that we've talked about for the past few weeks, and it's still not getting any more clear. The tariff conversation being kicked down the road is not necessarily something that I mean, I think that the market here is looking for any kind of way to grasp at straws as far as good news. And that to me is another thing that may be not a great sign because anything that is either tariffs being kicked down the road a few weeks or whatever is enough for the market to come in and say, hey, let's really like stage a rally here. And so that to me would maybe suggest that it's not a rally that is going to be um, able to be sustained on a long-term path because it's not built on um, what we would consider to be solid footing as far as wide participants of those rallies. It's still very narrow. You just have issues there, and so it kind of leaves us scratching our head. It's kind of leaves everybody else scratching their head about what exactly is going on, and it's only going to be revealed in time. So it may feel like we're sort of, your head is swimming right now and what's going on and the market's going up and but there are still underlying concerns that we have and they're showing up in our indicators. So that's all we can do because we're
Yeah.
rules based and we follow rules as far as the models are concerned. And that's all we
Well,
can do is look at those and say, hey, you know what?
let's talk.
The data that we're looking for, we're not seeing, and our indicators are not seeing either.
Yeah, let's talk about what are you seeing that could start to change that? Would it be uh, tax policy? Would it be the end of QT? What are you looking at that just from your bias would start to build a stronger foundation for a continued run?
So I'm going to go back to the things that I've talked about a lot, which is market breadth. I like to see wider. Uh, I like to see more participants of the upside. It doesn't need to be so narrow. It's not an advancing like tech companies. We're not back in an environment where the Mag 7 is the only thing kind of taking off. And because those participants are such large parts of the indexes that the indexes rise only because of that. And I think that's what we saw last week. Certainly, it's borne out in the data that there was, not a whole lot of participants there that I would think. Um, the bond market definitely, we're still seeing, um, elevated yields there in the bond market that would be suggestive that it's not suggestive that we are. It's a double negative, but it's not suggesting that we are clear of a recession. So there are a lot of things there that we would like to see. The QT is still going on to a certain extent. There's been talk about that kind of slowing down. The Federal Reserve is still very kind of close to the chest about interest rate, lowering the interest rate. I think that's another thing you have to see. They're waiting for some like specific data. They're holding hard and fast to the 2% number. So I think there's still a lot of things that could make it go uh, the way that we would not prefer it to go. I don't think the market environment is perfect yet for a sustainable, another bull leg. But again, I could be wrong too.
Yeah,
There's
I mean,
always
I'll
that
get the,
possibility. Because
and I'll
because
give
we're
you
we're
the.
such we're in such a spot where the market continues to surprise.
Yeah, I would just give you the no, it's not really the flip side, but a lot of times what what as a retail investor, what you feel and what you're using to make decisions has already been priced into the market, and the market is looking forward, the next 6, 9, 12 months from where we're at. I think the trend is a continued growth from our lows of the M2 money supply, which is is bullish, and the trend is lower rates. But to your point, how fast do we get there? And this is why paying attention to the data is so very important when you're looking at your portfolio, because you don't want to be making decisions purely based on your personal perspective or your bias, because you're going to miss out. And we've seen this time and time again, specifically during COVID, when the financial markets were collapsing. Had a lot of people reach out and made the right decision to not stick their head in the sand and pay attention to the data that we were presenting them, and that set them up for one of the best bull runs they'd ever experienced. So yeah, it's very interesting. Time will absolutely tell as we continue to pass through these next few months of the summer, and really paying attention to what's happening with kind of the battle taking place between the trend of CPI going lower and what I would posit as the stubbornness of the Federal Reserve to simply continue to do what they committed to do last year.
We've got a lot of Federal Reserve speeches coming up this week, today in particular, happening kind of as we speak, in some respects. So we'd be interested to see what they say. We've got some more happening tomorrow. Um, really all week, Federal Reserve speeches from governors and presidents. We've got our jobless reports coming on Thursday, and home sales. So we'll see where that takes us, especially in light of the downgrade of the U.S. credit rating. We'll see kind of if we see um, any kind of indication there. The market must have just opened because my light turned red. So we will, we'll keep an eye on it for sure. But I think we're at the end of our time today. But we'll definitely keep everyone posted on what we're looking at uh, through these events and this sort of volatility that's concerned. But I would just say that that's still the name of the game. That's still the common theme for us that we're looking at is volatility. I would say is not over. So just kind of keep that in mind.
Yeah, absolutely. Hope everybody has a great week. Feel free to visit us at momentumwealth.us if you have any questions or concerns about your current portfolio setup. We'll walk you through how we help our clients navigate these periods of volatility, and also give a nice education on how volatility presents enormous opportunity that you may not be taking advantage of with your current setup.
Yep, well said. And we will be back here next week, hopefully in the studio next week. And we will be there for more of this. But yeah, have a great rest of the week, and we will see you guys later.